Hey, loan officers, we got a great gig for you. You need to do this. If you would like to have one-on-one training with an Oak Tree Funding account rep to learn all of their products, forwards and backwards, so you can just pull them from your memory whenever you're having a conversation with a referral partner or a client, know what program to actually put your clients in and how to market these programs. NonQM is 2022. It's going to define it. Oak Tree is here. They're offering you right now free one-on-one training so you can be set up for 2022. Don't miss this opportunity. Click this banner right over there. Hey, do you guys want to know what's kind of funny? After a couple volatile days with rates and after a couple of moves by the Fed, guess what? Mortgage interest rates actually dropped after a quiet 2-week rally of higher interest rates. Now, Sam Cater, Freddie Mac's chief economist, said in a statement, he said, following a month-long rise, mortgage rates effectively stayed flat this week. We do expect rates to continue to increase, but at a much more gradual pace. But in the meantime, guys, the average 30-year fixed rate mortgage declined 1 basis point from a week prior to 3.55% during the week ending January 27th. And again, this is according to the latest Freddie Mac PMMS mortgage survey. Now, to put this in perspective, a year ago, the 30-year fixed rate mortgage average was 2.77%. And most economists believe rates will continue to climb in the weeks and months ahead, but just not right now. In fact, the Federal Open Market Committee, the FOMC, as you probably hear it referred to, said with inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the federal fund rate. So higher rates are coming, like I said, just not last week. But here's a side note when it comes to higher rates. The Fed raising rates is and will have serious consequences when it comes to our out-of-control national debt. When they raise rates, it raises on the interest that we pay to those that hold our collective federal debt. Get this, according to the United States Treasury, in fiscal 2021, the amount of interest paid on the national debt was $562 billion, including government transfers. The amount actually paid out to holders of U.S. securities was $413 billion, and higher rates means that number is going to continue to go up. To put this in perspective for you right now, the $413 billion that we paid in interest to holders of these securities to the annual budgets of other parts of our government, the State Department's annual budget, guys, is only $35 billion. And the Justice Department, $39 billion. So $413 billion in interest alone? It's kind of scary, isn't it? And finally, at this rate, in just a few years, over half of every dollar we pay in income taxes is going to pay the interest on our national debt owned by the public. And it's going to get worse. But back to interest rates and the mortgage market once again. You see, I bring this up because rates, as they move in trends, is what you should be following, the trend. Follow rates because that will affect how and what you market. Rate trends give your business the coordinates for setting your professional market bearings. Rates moving intraday, well, my thinking is, since your comp is set as a loan officer, just lock the damn loan. There's no benefit in floating things. See, for those of you who've been writing loans post-2010, understand, prior to 2010, you could pick your own comp, and if there was any overage on that interest rate, then you got that as the loan officer. That money went to you. So say you quoted a rate of 7%, and you did not lock that rate, and then rates went down to say 6.75%. That 7% rate you quoted would now be paying an additional, say, 100 basis points. On the other side of this whole thing, if you promised that 7% interest rate and rates got a quarter worse and went to 7.25%, then say you would have to buy that rate back down to 7 by paying 100 basis points, and that would come out of your pocket. So prior to 2010, floating rates was really gambling with your commission where you could win big or you could lose big. And it was actually kind of fun when you won big. That's all gone. So why on earth would you ever float an interest rate? It's like the old saying goes, George Kubiak, you're out there somewhere, my old mentor, you salty dog you. He once told me, as a young loan officer, Brian, lock it, dock it, and put the money in your pocket. Hey guys, make it a great day. I will see you tomorrow, Tuesday, here on the National Real Estate Post.